Hi, my name is Paul Sunnan, and I'm with Empyrean. Today we're going to talk a little bit about entity structures. We're going to talk a little bit about how those entity structures specifically can impact your cash balance plan or defined benefit plan. Clients come to us all the time and ask us, well, I'm a sole proprietor, I'm thinking about becoming an S-Corp and things like that. How is that going to affect me, and how does this affect my funding, not only my funding levels, but the complexities of adding it on your tax returns and everything like that. So today we're going to address some of those topics and give you some things to consider. Before we jump in though, make sure you like the video, subscribe, hit the subscribe button, and you can have access to all the other videos that we have out there and future releases. In addition to that, please leave a comment below if you've got any questions. We do review those from time to time. Many of you may know that I am a CPA and I've done thousands of tax returns. I don't do many tax returns anymore. In fact, I try to do as few as possible. But bottom line, I'm very familiar with the different schedules and how to put these on the tax returns. I will say that the IRS continues to make tax returns more complex, add additional lines and things like that. So I might not be up on all the details, but in substance, I've got a real good idea on how these plans affect the different types of entity structures, and to give you an idea on how you can kind of structure a plan, and at least some things that you're thinking about or should consider if you're looking at changing your entity structure. For us, most of our clients have S-Corps, okay? But probably number two would be sole proprietors. We'll talk a little bit about sole proprietors first. Sole proprietors, very simple and easy. LLC could be a disregarded entity. It's just going to file a Schedule C, which is just a separate schedule to your tax return. You're going to be subject to all federal and state, and also Social Security tax on all of it. Very basic, simple structure for a lot of people. Okay, a lot of I would probably say a third of our clients have sole proprietors. Okay, sole proprietors are great. They're simple and easy. They're not as tax efficient, but obviously they're a little cheaper. You don't have to put yourself on W-2. They do make these plans a little bit more complex, because when we look at these plans, there's a few things that tie into the contribution. One is going to be age. Obviously you don't have a lot of control over that. Compensation, the investment returns, the formula in the plan. So there's going to be a variety of criteria that's going to tie into how much you're going to need to contribute to a plan and how much you want to contribute to a plan. But the biggest driver in one of those would be compensation. And when you've got an S-Corp structure or a C-Corp, we'll talk more about those, you've got a defined wage. You've got a W-2. Let's say it's $100,000, $200,000. That's a set number. We have compensation that we can do. When you're a sole proprietor, there's somewhat of a complex calculation whereby we have to take your total business net profit, and then from that we back out a contribution to the plan, maybe a contribution to a 401k profit sharing, and then based on the formula we have to come up with sort of your defined compensation. So it gets very complex, and obviously it's going to be driven by age and a variety of other criteria, but let's just say, as a good ballpark, we might say it's half. So if you made $300,000 on a Schedule C, a lot of people will say, well, my compensation was 300 grand. No, when we go and calculate your plan, your compensation might be, and again, this is just sort of an educated guess and it depends on age and so forth, but maybe it's 150,000, okay? So it's a moving target, bottom line. If you make $1 million, $100,000, obviously that's going to be moving. Typically the wage for sole proprietor is really going to cap out, again, depending on age levels, 600 grand or so. So once you get above that, it's not going to change much. But obviously you've got a sliding scale with your sole proprietorship, and the more you make, the more higher your wage is. Okay, so it does make the calculation for us a little bit more complex. For you, the client, it's a little bit more complex because you still have this moving target. So there's a variety of things that you need to consider. But again, definitely doable. A lot of our clients have sole proprietorships. It's just a little bit more complex. Second, the most popular structure that we have is probably, let's just say 60% of our clients have S-Corps. S-Corps, we love them, very simple, easy. You've got a set wage. Your compensation is 100 grand. We use that, we tie it into your interest crediting rate, your pay credit rate. We can calculate a min-max and a target pretty easy. So S-Corps are rather simple and straightforward for you. They have a lower audit risk profile, and they're actually a very good return for some of the larger business clients. Sometimes clients say, well, should I be an S-Corp? Well, it depends. Certainly, I'm not your CPA. I'm not doing your tax returns. So, one of the reasons why people like to do S-Corps is because they can minimize their employment taxes. That's not as big of a deal for our clients because we deal with a lot of high-income professionals, attorneys, accountants, physicians, and so forth. A lot of them will already be at the Social Security cap around 150 grand or so. So, an S-Corp isn't as big of an issue for us, but it does give them a little bit more flexibility when they're trying to determine reasonable comp, what their calculation levels are, and it's a little bit easier for us when we go to use the formula to drive the actual funding range that we're going to do. So again, I think S-Corps are great. I think they're great for business owners, especially if you're going to earn consistently high income for a longer period of time. I think that's something you should consider. But maybe if you're starting your business, you just stay at a sole proprietor or whatnot. C-Corps. Maybe 5% of our clients use C-Corps. Don't see them as often. Main reason is C-Corps are a self-contained, self-taxed entity. They don't have flow-through taxation like an S-Corp or a partnership would. So C-Corps are only used in certain situations. Often it might be a physician group where there's a lot of shareholders to the group. It can be the situation if there's a lot of other investors or other things like that. It can make sense to have a C-Corp. But for the small family practice or the independent physician typically doesn't make a lot of sense. If you're going down the C-Corp route, C-Corps can be great with tax reform because now you got a C-Corp rate of 21%. So if you're in a high tax rate, you can have some income, although it's different for professional services, but depending on the type of business you have, you can keep some of your income in there taxed at a lower rate. You have to weigh that with not getting the Q-bid deduction and some of the other things that are out there. So it can be an option for some people. It does raise a lot more complexity in one respect when it comes to funding these. Like an S-Corp, we still have a W-2. C-Corps and S-Corps are required to have W-2s. So we still have that W-2 for the reasonable comp, but since the C-Corp is a self-taxed entity, you often, if you've got a profit of $100,000, well, if you want to contribute $150,000 to your plan, well, that's going to create a loss of $50,000. In a lot of situations, that's not going to do you any good. Now, you can carry it back, carry it forward, variety of criteria that you can use there. But generally speaking, you'll want to keep that net loss, if you can, kind of close to break even. These plans can work great sometimes for S-Corps because with your funding range, you can use that funding range to make a contribution that's just going to get you kind of to break even. So it can make a lot of sense. However, we do see some issues sometimes where clients maybe want to contribute more, they can't. So now they've got a higher profit on their C-Corp than they want, and now they've got to take dividends out. And so there can be some other complexities. So C-Corps can make sense. They're definitely not for most folks. But again, in the right situation, they can make sense. If you think a C-Corp is right for you and you want to talk about how that ties into your actual plan, you're welcome to reach out to me or discuss it with myself and your accountant, and we can see at least how the C-Corp structure is going to work for you with respect to this plan itself. Now, the last entity structure is going to be a partnership. Partnerships we see for professional service businesses, sometimes husband and wives, a lot more complex because the contribution does not go on the face of the 1065 on the return. It actually goes on the K1, and these are the contributions for the owners. If you've got some employees, they could go on the 1065, but for the employers, they're going to show on the K1, and it makes it a little bit more complex. Partnerships, again, that might be the only route you're going to take if you're part of a large medical group or law practice or something like that doing that. But partnerships is going to be probably the more complex route that you've got to take. But it does give you the ability to fund at different levels, which is a little bit different from an S-Corp. S-Corp, everything just pulls off those W-2s. You've got a little bit more flexibility on how that flows through on the partnership. So it can make sense. Again, something you'd probably want to discuss with your CPA and then also reach back out to me. Which entity structure is the best? Look, S-Corps are going to be the bread and butter for most businesses. It's the most, we do most of our plans are with S-Corp structures. But if you're starting your business from scratch and you're just setting it up, a sole proprietor might be the easiest approach for you to take. You don't have to worry about W-2s. You don't have to worry about the extra headaches. You're just filing one tax return. Your tax fees are lower. In fact, an LLC starts off as a disregarded entity, so it starts off as a sole proprietor, but then can also elect to be taxed differently, like an S-Corp or even a C-Corp for that matter. So again, if you're starting your business, maybe sole proprietor makes some sense. If you're a professional services business and you plan on doing this for a while and you've got high income, typically an S-Corp is going to make the most sense for you. And it's really going to give you the ability to control the contributions on your retirement plans a little bit more because you've got that defined W-2 and you've got a little bit more control over it, unlike what you might have for a sole proprietor. Hope you learned something from this video. Hope I educated you. Again, if you can, like the video, subscribe below, leave us a comment. Down below also, we'll also have a couple links to where you can set up a call with us and get an illustration. Love to help you out and discuss your entity structure and how it impacts your retirement planning.